Okay, so today we're going to look at depreciation, which is another adjustment to the final accounts that we may have to do, just like accruals and prepayments. So we're going to look today at depreciation, what it is, how it's calculated, the accounting entries for the ledgers, and where it goes in the financial statements. So depreciation is the loss in value of an asset over time. So assets obviously lose value just like everything else. So the more you use it, the less value that it will have. Now we have to record that as accountants. We have to record the fact that our assets aren't worth as much as they used to be. We have to make sure that our balance sheet shows the correct current value of our assets. So for example, if you were to buy a Lamborghini today for £100,000 and then you were to drive it for the next 10 years, it's not still going to be worth £100,000 in 10 years time. So you'd have to record on your balance sheet what it's worth at that date. So this is why we calculate depreciation, to ensure that we're showing the correct value of the assets on the balance sheet. So it's calculated by a business as a forecast of how much value an asset has lost through regular use. So as the asset loses value, it's going to have two effects. And this is very, very important. Obviously, in accounting, everything has two effects. So the first effect is we create an expense on the income statement. So we debit the income statement or debit a depreciation expense. You can use either. You can either debit directly to the income statement or profit and loss, or you can create a separate depreciation expense account. Just for ease of learning, we're going to do it through a depreciation expense account today. I would like you to continue doing that this year. It's the easiest way and it's totally acceptable. It might just add an extra step to what we're doing, but it's the easiest way to learn. So you're going to debit a depreciation expense and you're going to credit something called a provision for depreciation. Now, provision for depreciation appears on the statement of financial position, and we'll show you exactly where that goes in a minute. So firstly, that expense. Now you're going to calculate the expense. You're going to calculate how much value an asset has lost over a year's period. Now you're going to do that through a formula, and the amount that you calculate, the amount that you see on your screen on your calculator once you've pressed equals, that's going to be the expense that appears on the income statement. So it's the amount of value that the asset has lost in the current accounting period. So on the income statement, we're allowed to spread the cost of the asset. Obviously, we're used to assets going on the balance sheet, but as they lose value, we're losing value from our company, and that will reduce profit. So when you calculate how much value an asset has lost over the year, that's going to be an expense on the income statement. Now, it's not something that you actually pay for. It's just showing that the asset is losing value and therefore it's reducing your profit. As I just said earlier, what we're doing is we're spreading the cost of the asset out over the years that we use it. So every year that we use it, we use a certain proportion of its value. That proportion becomes an expense. Over time, we will use all of the value of the asset, so it will have gone down as an expense over several years. So it's for the current accounting period only. The expense is just for the current accounting year. That double entry goes to the provision for depreciation. Now, the provision for depreciation appears on the balance sheet, and the provision is the total amount of all those expenses added together. So when you create the expense, you will debit the profit and loss, or as we've said, debit a depreciation expense. and you'll credit the provision. So the provision accumulates all of those expenses and adds them up so that we've got the total amount of value that that asset has lost. Now, the provision appears in the non-current assets section of the balance sheet. Once we've got our provision, we can calculate something called net book value. Now, net book value is the carrying amount of an asset. By carrying amount, what I mean is the current value, what we believe the asset is worth. Now, that's calculated as the original cost of the asset minus the provision for depreciation. So you buy an asset for £10,000. Every year it loses £1,000 worth of value. So after, say, 6 years, it's lost £6,000 worth of value. So your provision will be £6,000. So your original cost was 10,000. Your provision is 6. Then the current value or net book value of the asset would be 4,000. Now, this again appears in the non-current asset section of the statement of financial position. And we total up the non-current asset section using the net book value, because that tells us the current value of all of our assets. So what causes depreciation? Depreciation is caused by loads of things. Usually it's caused by everyday use or wear and tear. So just by using an asset, you will cause it to lose value. Erosion and decay, you leave something outside in all weathers, it's going to get eroded, it's going to get decayed, it's going to get moldy. That will make an asset lose value. You've also got things like depletion. That tends to happen more when you've got something like an oil well or a diamond mine. As you take oil or diamonds out of your asset, you are depleting its resource, so it's losing its value. Sometimes assets become obsolete, and that means that it's no longer up to the task. It's been replaced by newer technology. So you might have had a really expensive typewriter. Once the desktop computer came in, typewriters became obsolete. So all the typewriters that your company owned would have lost a lot of value straight away. Sometimes assets just become inadequate. They're not useful to us anymore. We might have outgrown them or something. So that will also make it lose value, and as will the passage of time. So assets just lose value as we use them over time. And we've got to make sure that we record how much value these assets are losing. Now, the two main methods that we're going to use are straight line and reducing balance method. So there's some formulas that you've got to learn, and you've got to memorize these because they won't be given to you in the exam. You're just going to have to recall them off the top of your head. So the straight line method has actually got two different ways of calculating it. The first one is where we take a fixed percentage of the original cost off the asset each year. Example, we've got an asset which cost £20,000. The depreciation is written off at 10% on cost each year. So every single year, we're saying that asset will lose £2,000 worth of value for 10 years. So that percentage never changes. Once you've decided on the percentage to use for depreciation, you have to stick with that for the life of the asset. So we know that that will be £2,000 every single year as an expense on our income statement, and our provision will increase by £2,000 each year as well. The next way to calculate it is using a formula, which is cost minus estimated residual value divided by number of years of expected use. So cost minus estimated value, residual value, sorry, gives us what we call the depreciable amount, the amount that the asset can be depreciated by. As residual value is also known as scrap value or trade-in value. So what it originally cost minus the amount you'll get for it when you're done with it, divided by the number of years you're going to use it. That's going to give us our depreciation amount every single year if we use this method. Now, in the exam, you will know to use this method if they tell you that there is a residual or scrap value of an asset. So here's an example. We purchased fixtures for 4,600 on the 1st of January 2020. Useful life is going to be 4 years, after which time it will be replaced. It's going to have that trade-in value of £400. So we're going to calculate the depreciation charge and show the provision for depreciation for 2 years. We're going to show it for 2020 and for 2021 as well. So the first thing we're going to calculate is that annual depreciation charge, the amount that's going to go on our income statement. So remember what I said, what you type into your calculator and when you press equals, the answer that comes up, that is the amount of the expense. You'd have typed in 4,600 minus 400, so cost minus residual value, divided by the 4 years of life, and you'll get 1,050 appear on your calculator. That will be the expense for the year. So, in terms of the double entry, what we would do is we would debit the depreciation expense and credit the provision for depreciation. So we've got 1,050 on the debit of the depreciation expense, 1,050 on the credit of the provision. At the end of the year, we transfer to the profit and loss 1,050 as the expense. Now you can, as I was saying before, you can just do it straight to the profit and loss. So you can debit the profit and loss in the first instance and credit the provision. But using a depreciation expense just makes it clearer to us, makes it more obvious what we're doing. And I'd like you to keep doing that. It's going to help us with further topics. So just to repeat that, in 2020, we debited the depreciation, we credited the provision, and we transferred to the profit and loss the expense, and then we carried down and brought down the provision. That one goes on the balance sheet. So in terms of how it would look, on the income statement, we've got that expense of 1,050, and on the statement of financial position, we've got the fixtures at cost of 4,600, depreciation of 1,050, so a net book value of 3,550. Cost minus depreciation gives us our net book value. So when we get to 2021, again, the expense is 1,050. We debited the expense and we credited the provision. But as you can see, the provision already had last year's 1,050 in it. We've added to that with this year's expense. So the total amount of the provision is now 2,100. So that, as we've had it 2 years, it's now got 2 years worth of expenses in that provision. When we come to the financial statements, we've again just got the year's charge on the expense. And on the balance sheet, we've got a provision now of 2,100. So the asset is now worth, after 2 years, £2,500. So let's just look at that again. So in 2020, we just had 1 year's charge to give us a net book value of 3,550. And then we added to the provision in 2021 with an extra year's charge. So our provision became 2,100. And now we can say that our asset, after 2 years worth of use, is worth £2,500. The next formula is the reducing balance formula, or the reducing balance method. This is calculated as a percentage of net book value. Now, what this means is that each year the calculation will provide a different amount of depreciation because your net book value changes every year as the provision increases. So whereas straight line gives you the same answer every year for your expense, your reducing balance is going to give you a different amount every year. So here is an example. So Circab owns a machine with a cost of 45,000 and it's already been depreciated. So it's got an existing provision of £20,000. So he's obviously owned this quite a while. But at the 1st of January, it's got a cost of 45,000 and a provision of 20. Now he's going to calculate his depreciation 20%, reducing balance. So again, we're going to do 2 years just so you can see. In the exam, you'll have to do 1 year. I'm just doing 2 years so you can see the effect of the increase of the provision. So for 2020, we calculate the net book value. So the cost minus the provision gave us £25,000 net book value. The expense is then that 20% of the net book value. So it's £5,000. So the double entry would be to create the expense for 5,000 and to increase the provision to 25,000. There you go. We've got the debit to the expense for the £5,000 expense, the amount that was on our calculator. The double entry is to credit the provision there. Debit the expense, credit the provision. So remember, we had an initial provision of 20,000. So our increase of 5,000 gives us a brought down figure at the end of £25,000. See that in the financial statements. So charge of 5,000. And then the non-current assets are worth £20,000 now at net book value because our cost is 45 and we've increased our provision to 25. So when we get to 2021, as the provision has risen to 25,000, we've now got a net book value of £20,000 in 2021. But we need to work out this year's charge. Now, as the net book value is £20,000, 20% of that is 4,000. That's the amount on our calculator, £4,000. So that's going to be the expense for the year, and the provision will then rise at the end of 2021 to £29,000. So again, double entry. Debit the expense, credit the provision. £4,000 as an expense. £29,000 becomes our closing provision. So on our financial statements in 2021, depreciation charge would be £4,000, and our net book value goes down to 16. 2020 it was 20,000, and in 2021, because of that accumulation of depreciation, net book value goes down to £16,000. So why the names? Why are they called straight line and reducing balance? Show you as an example. So we've got a machine for £8,000, going to be kept for 4 years, and then it'll be disposed of for £500. Now the accountant's going to ask us to prepare a comparison of the amounts charged as depreciation using both methods. So if we do it in a table, we can see using the straight line method, we get the same depreciation amount every single year at 1875. With the reducing balance method, we see a really high charge in the first year of £4,000. Then it drops to £2,000 in year 2, 1,000, and then 500. So the straight line method is the same expense every single year, whereas the reducing balance method, well, it goes down every year because the net book value goes down. However, you can see that they both end us up at £500 as a net book value over the 4 years. So they're both exactly the same. The reason that some companies will choose straight line, some will choose reducing balance is, well, it actually really depends on the type of asset it is. So for example, technologies and motor vehicles tend to lose most of their value in the first year. So for example, if you buy a brand new car, you go to the garage, you buy a brand new car, it's got 0 miles on the clock. As soon as you put your key in and you turn the ignition, that car loses about 25% of its value, simply because it's now second-hand. So reducing balance method takes away most of the value of the asset within the first few years. So it's a more accurate method for items like vehicles and modern technologies, which go out of date quite quickly. Whereas the straight line method is better used for tangible assets that aren't technology based. So fixtures and fittings, for example. So your shelving units, they're not really going to lose most of their value in the first year. They would be losing their value on a consistent basis every single year, simply due to the passage of time. So it really depends on what type of asset you've got as to which method you would choose. So as we've calculated it, I've just plotted it in a graph, and I've plotted it in a graph from what looks like 1960, but it was the best I could do. What you can see is that the straight line method is plotted on the graph in a straight line, because the net book value of the asset goes down equally every single year. So when plotted on a graph, it gives us a straight line. That's why it's called a straight line. Whereas the reducing balance method is more curved. It obviously still goes down, but most of the value is lost in the first year, a bit less in the second year, less still in the third year, less still in the fourth year. And that creates sort of a curve to our graph. So we call that one the reducing balance. So a couple of tips. First tip, single most important thing for you to remember with depreciation is the amount you calculate using either formula is an expense for the year. So that amount on your calculator is an expense for the year. And don't forget to do the double entry and increase the provision for depreciation. Provision for depreciation reduces the value of the asset shown on the balance sheet. Remember that cost minus the provision is known as the net book value. So the provision includes all previous years and this year's charge for depreciation. So when you see provision for depreciation in the trial balance, do not put it on your income statement, because it will have far too big of an expense. You only want 1 year's charge, not every single year's charge as is found in the provision. So don't put your provision on your income statement. Remember, just this year's expense on the income statement and the provision on the balance sheet. I will be saying this an awful lot. You probably will put the provision on your income statement. If you do, you're going to massively mess up your income statement, and also your balance sheet will be wrong. So don't do it. Okay. So here's some stuff for you to bring with you to your next lesson. I want you to calculate the depreciation charge, the provision for depreciation, and the net book value for the following. So we've got a couple of straight lines and balances. All right. So calculate those, bring them with you to class, and I want you to present them in the same way as I have done on these slides. Entry of how it would look on the income statement and balance sheet. There you go.